Hello, my name is Phil Blancato. Welcome to the LTAM Asset Management third quarter market commentary. For the next few minutes, I want to try and give you some insights as to what took place in the third quarter, maybe some ideas of what we expect going forward for the rest of the year. Well, the third quarter was an interesting one. There were lots of negative headlines, situations in Europe and the United States that really brought great misunderstandings into the marketplace. But in fact, both the bond market and the equity market held up pretty well. For the most part, more so than expectations. When you think about the overall global economy, it continues to struggle. There are areas around the globe that aren't growing, like Europe. Japan dealing with wide demographic issues, and then China has some unknowns as to what's really taking place in the Asian Pacific continent. In total, the globe is sort of stuck in this no-growth mode. The United States, in a slightly better situation, is growing very modestly, but on total, this is a new paradigm. Perhaps you've watched other video commentaries in the past where we were maybe a little more optimistic about total growth. But at this point, we seem to be in a situation where we aren't growing real fast, but not totally recessing either. Part of it is because global central banks, places like our Federal Reserve or the European Central Bank, China, Japan, are being very accommodative. What does that mean? They're letting lots of cash flow through the economic systems to try and stimulate lending and try and stimulate growth. Reality is that's not working. But it is helping to support the broader stock markets and broader bond markets, depending on which country you're in. More specifically, when you think about overall growth, the United States is growing just about 1.5% on average per year. Many of you remember we used to grow at around 3.5% to 4% per year. So we're significantly below where we were historically. There are lots of reasons for that. As a country, we are less productive today than we were in the past. But that's also because of demand at the consumer level is less than what it once was in the past. Think about the boomer generation today has less demands for goods and services than they did a few years ago. And that's not just a U.S. phenomenon, that's a bit of a global phenomenon. What does it all translate to? Basically, an economy that grows modestly. When you lump on some headlines, like the election cycle, like the Federal Reserve maybe or maybe not raising interest rates, it can be problematic for markets. But in total, when you think about the equity market in the United States, it's really not that bad. We're in a bit of a Goldilocks situation. Our economy isn't growing too hot, where the Federal Reserve would have to raise interest rates and we have runaway inflation. And it's not recessing, it's not slowing down. Things like oil have really helped our economy, helped the equity market specifically. Oil being so low, 80% of companies in the United States benefit from low prices. You, the consumer, benefit from low prices. We're a consumer-driven economy. And in that mindset, the consumer today has $2 trillion of less debt right now than they did in 2008. It's pretty important to realize that if the consumer is the main driver and things like inflation and interest rates and oil are low, we're going to be able to stay in this sort of mild environment. We're not overly productive. We're not growing real fast. We are adding some jobs. The labor market is definitely better. The labor market has improved and has been improving for some time. There's still probably 8 to 10 million people that are underemployed or looking for work, but there's about 14 million people that went back to work. Maybe they expected to make a little bit more money than they are, but by and large, they're being contributory to the overall economy. So what does that mean? I mean, the stock market is just kind of trudging along. We do have a situation now where after years of growth, after years of a successful stock market, it takes real earnings, more earnings of our U.S. corporations to drive the market higher. And unfortunately, that's probably not the case right now. We seem to have leveled off on an earnings cycle, and the only way to get the stock market higher would be through companies paying less on their debt or buying back stock. We need a stronger earnings cycle, and it doesn't seem to be in the cards right now. So our expectations for the equity market are pretty much right about here, especially going into this type of time period where the election, the Federal Reserve, and some other issues are holding the market back. But all still, market's up over 7% for the year, so that's pretty good for the U.S. stock market. International market's a little different ballgame. Remember something called Brexit. Brexit was when the UK decided to leave the European Union. Created waves of volatility. In fact, the European markets are up only about 1.5% year to date. Europe in and of itself is growing really slow and almost flat. They've got loads of debt, more so than we do. They got very high unemployment issues. Even their banking system, places like Deutsche Bank and the big banks, are really struggling to stimulate lending and make any money. So unfortunately, Europe is basically stagnant. There's just not a lot of growth there. For that reason, we don't have a large allocation to Europe anymore. In fact, we have the smallest allocation to European stocks that we've ever had. While we think the long term there's value there because stocks are really cheap, we need to see growth. And there really isn't a lot of growth there because of their debt, because of their demographics, and because their inability to grow themselves out of this cycle again because of low demand from their consumer and low productivity. When you think about emerging markets, it's been an interesting story. Emerging markets have been better this year. We haven't had emerging markets in the portfolio for some time. The reason being there's lots of volatility in emerging markets. There's an old saying, you go up on an escalator and down on an elevator in emerging markets. And that's been the case the last few years, having to take on a lot of risk for not a lot of return, especially because they're commodity related. With oil correcting and going down, emerging markets got really hammered last year. Now they've rebounded this year and bounced back, but it's really because of the price of oil. So until we see them be more independent of oil and really start to grow again, we're going to stay out of emerging markets. Interesting sector, but too much risk. In the long term, they got young populations and low levels of debt, so they will be good again. We just don't think we're there yet. The bond market's a very difficult place. The bond market is one ripe with speculation. Believe it or not, the 10-year U.S. Treasury back in late June hit the lowest point in history at 1.38%. That's a very low yield for owning 10 years worth of government paper. Believe it or not, the bond market is really full of speculation because interest rates being so low, even a modest raise in interest rates would cause a loss in fixed income. So the fixed income market is a little bit speculative. On the positive side, the U.S. bond market is really sort of healthy. And the reason being is we're the only developed nation on the planet that's actually giving a positive yield. 60% of government debt is now returning negative yields, meaning you buy a bond in a foreign country, you don't make any money on it at all. And in some cases, you have to buy it at a price that's more expensive than what you would mature it at. That's how they become negative. So negative interest rates are not a good thing. In the United States, we have positive rates. And for that reason, lots of people like our bond market, and it's kind of holding on. But we have lots of concerns about the bond market. You don't want to own bonds that are going to mature too long out because if interest rates start to rise, and our Federal Reserve is talking about raising interest rates, it can get pretty scary in the bond market. So we keep a short maturity, higher quality to limit any kind of pain that might come. We kind of see it as keep the quality high, earn some income, don't take too much risk in the bond market. So overall, when you think about where we are, there are three major themes. One, you've got the election cycle, and generally that brings in lots of volatility. So we're being very cautious about what's going on in the election. We want that to play out. At LTAM, we are apolitical. We don't choose sides, left or right. So it's indifferent. We want to make you money based on what they do in Washington. So we want to let that scenario play out before we get too more aggressive on the market. So today, we're a little more conservative than we've been. We actually may have noticed back in August, we took some money out of equities. We increased the credit quality in our fixed income and added to our alternatives to protect the portfolio. But we also brought in income in the form of preferreds. So we're generating high quality income and we're protecting in the portfolio a little bit more than we have in recent memory. The election is something we're concerned about and monitoring it quite carefully. Then you add on the Federal Reserve. The Federal Reserve wants to raise interest rates. When the Fed starts to raise interest rates, it can be bad for both the stock market and the bond market. And for that reason, we took a little bit of our allocation of stocks off, cleaned up our bond allocation by making it a little bit higher quality. And for that, and because we're concerned about the Federal Reserve raising interest rates. They sure want to do it. Usually they do when the economy is much hotter, when inflation is going higher, but they want to have some ammunition in case a recession comes. Now, a recession we don't think is in the cards. Not with oil this low and inflation this low, interest rates this low. But the Federal Reserve sees the bond market and sees the overall unemployment market and the U.S. economy hanging in there. And for that reason, they probably want to raise interest rates more than likely in December, which could also bring in some volatility. And I already mentioned earnings. We'd like to see U.S. companies start to earn again, start to get their productivity up. And in order for that to happen, things like regulatory changes around taxes, unemployment, global growth really need to improve. And until we see that, it's hard to get more aggressive on equities. So to conclude, it's a Goldilocks economy. To tell you the truth, we're in this sort of not too hot, not too cold scenario. We're trudging right along. We have higher quality in the portfolio on both equity and fixed income, and we're waiting for some of the major headlines to get past. However, that last month of the year, going into December, should probably be pretty good. We'll get past some of the issues. We'll have what we call Santa Claus rally, the consumer spending on the holiday season, and hopefully we'll end the year where we are right now, or maybe even a little bit higher. Hopefully this short video gives you some insights to where we think we are in the economy. If at any time you have questions or concerns about your portfolio or about this video or anything we're writing about, please contact your financial advisor. They'll grab us and we'll gladly answer any questions you might have about the economy, your portfolio, or whatever else we can help you with. Thank you very much. Have a wonderful, healthy, and happy holiday season. Take care.